So hello everyone, thank you for joining us today. My name is Chloe and I'm a research analyst from IFA Singapore. For today, I will be sharing more about what is happening within the commodity space and why we think that oil prices could actually reach $150 going forward. So here's the outline for the presentation today. I'll be sharing on crude oil in particular, as this is one of the most highly traded commodities out there. And it's also a major source of the global energy supply. So much so that an analysis of the commodities market will not be complete without looking at what is going on within the crude oil market. So to start off this presentation, I'll be sharing some of the factors behind this commodity super cycle which we are currently witnessing. And beyond this, we also see this longer structural trend on underinvestment that is bullish for the overall sector. Not to mention, in this inflationary environment in which we are currently in, commodities, they help to serve as a useful inflation hedge. And last but not least, with all this being said, we think that oil prices could remain elevated and could even reach $150 a barrel. So in the next slide, there's no commonly agreed upon definition of what exactly is a commodity super cycle. But typically, it's been used to commonly describe a period where the commodity prices they rise above their long-term trend. So back when COVID-19 pandemic first struck us about 2 years ago, I think we all know that the world's appetite for raw materials, it plummeted. And with this, so that the demand fell and the prices actually collapsed. But yet, it was not long again before these prices were soaring as the global economies, they eventually and gradually recovered from the pandemic. And to make matters worse, what happened within this year is that we saw this Russian-Ukraine war. And this is a war that actually caused a massive supply upheaval, especially to this commodity space, and in a manner in which many of us have never seen before. As after all, this is not just a shock to the oil supply, but that to every single commodity out there, such as grains, cooking oil, metals, so on and so forth. So behind this commodity super cycle actually lies this demand-supply imbalance that's observed within this whole space. So on the next slide, when we look at crude oil in particular, I think this is something that we can relate to. There's an increase in global oil consumption, and this is attributed to the pent-up demand for travel, especially after lockdowns have been lifted and countries were now opening up their borders. So people were actually eager to make up for this lost time, especially in the past 2 years, and were now eager to get on board the plane to actually travel. So the total demand for air travel actually increased significantly in April this year. And you can see that in the table where it actually rose about 78.7% on a year-over-year basis. And this whole April air passenger data is actually a cause for much optimism, as you can see that air travel in general has increased across the various markets except for China, as they continue to have some restriction. So nevertheless, the message is that as the global air travel makes their long-awaited recovery, it brings with them a stronger demand for oil. Not just air travel, we see the case where this global demand for oil will actually continue to rise in the third quarter of this year as the Northern Hemisphere's summer driving season begins. So during this time, you'll see that there are lots of cars on the road, especially in the US, and this will be one of the most heavily traveled times within the year. So going forward, OPEC actually expects to see a strong global oil consumption as well as a strong global oil demand. So they're projecting about an increase of about 3.1 million barrels a day and to average about 101.8 million barrels a day in the second half of this year. And this is a pretty significant number as it will actually surpass pre-COVID-19 levels. And to make matters worse, while this demand is growing, we see the case where supply fears have actually worsened. So I think we all know that there are new sanctions against Russia now, given that EU members, they agreed on a partial crude oil ban that covers more than 2/3 of oil imports from Russia. So this is an embargo that covers Russian oil brought in by sea, and they allow a temporary exemption for imports that are delivered by pipelines. So why this is the case is because this was actually a move that was crucial to getting Hungary on board, and the EU needed to achieve some form of common consensus to get there. So all in all, the EU has also agreed to slash Russian oil imports by up to 90% by the end of this year. So as Russian exports, they fall sharply, the country's facilities will naturally start to cut production. So output, it tends to average at around 10 million barrels a day in May, and this may drop to about drop by around 1 to 2 million barrels a day, according to some analysts' estimates. And this International Energy Agency is going as far as to suggest that Russian oil production could actually drop about 3 million barrels a day. And in the next slide, we see the case where, despite all these fears being there, OPEC as a whole, they actually failed to alleviate a lot of their investors' fears. So OPEC, they committed to accelerate this output increase, but then again, we see that this group actually said they're going to add about 648,000 barrels of oil per day for July and August. But this is about a 50% more than previous increases seen in recent months. However, we do note that over time, OPEC as a whole, they struggled to actually meet these production targets. So if you look at this table here, you will see that in May, OPEC actually produced less barrels compared to April. So OPEC's production in May was actually down about 176,000 barrels per day compared to April. And this can be attributed to the shortfalls coming from Libya, Nigeria, as well as Iraq, for instance. So overall, OPEC has also produced about 2.7 million barrels a day below their production target. So I think this whole table illustrates to show that OPEC has actually failed to actually kind of alleviate supply fears over time. So in the next slide, other than that, I just want to highlight that within OPEC, not many of the countries, producer countries within them, have a spare capacity. So where it stands, only Saudi Arabia and UAE, they are the only OPEC nations with spare capacity. So between both of them, they have about 2.4 million daily barrels of unused output to deploy. But we see that this is actually unlikely to keep pace with the expected incremental amount of 3.1 million barrels a day as projected by OPEC. And not to mention that these current agreement terms between OPEC, they do not allow these nations to compensate for other nations who have production shortfalls. And furthermore, it's expected that this extra spare capacity from Saudi Arabia and UAE would be offset by even greater decline from other member nations such as Iraq, Libya, as well as Nigeria. And not to mention that we continue to see that this loss of Russian oil supply will continue to weigh on the global markets. As oil struggles to keep pace with the demand, it's natural we see that the world, they start to draw down on the existing crude oil stocks. And we see that overall, the crude oil inventories across the globe have actually been falling. But beyond this, we see this longer structural trend of underinvestment that is bullish for the overall sector. So I'll be going in detail within the next few slides. So underinvestment, they tend to precede a commodity super cycle. And this is precisely the underinvestment within the space that have been a key contributor to the shortage of fossil fuels. So this is unsurprising, as the oil and gas industry have been one of the most disliked as well as out of favor sectors within the recent years. And the simple reason behind this is due to many ESG concerns. So there are many ESG mandates out there that restrict capital to this industry that actually pose major challenges for a sector that badly needed new investments to keep up with the growing demand. So the result is that the annual investment in upstream oil and gas actually peaked at about 780 billion in 2014. And it has been on a decline ever since then, despite the fact that the world as a whole is still consuming record amounts of fossil fuels. So take, for instance, about 80% of our global energy needs comes from these fossil fuels. And if we look at the case of, let me give the example of oil refineries, for instance. So about just 2 years ago, the margins for refining oil, they were actually in the dumps due to the pandemic. And because of this, a lot of these refining capacity have been shut down. So about 4 million barrels a day of refining capacity has been shut down since the pandemic. And while the situation has now reversed, with these oil refineries now making record margins, as illustrated by the crack spread seen on this chart, we find that the waves of refinery closure since the onset of the global pandemic, they've already done their damage. As countries continue to pursue these net zero emission goals, we continue to see that we'll expect more refinery shutdowns with time, as this can be, after all, considered a rather dirty industry. So a key takeaway that I have from these two slides is that this is a sector that needs a lot of investment, and the prior underinvestment within this space would actually take years to rectify. So greater investment is needed to grow the supply and actually debottleneck the entire system in order to accommodate more demand for crude oil. However, ESG concerns will continue to prevent companies from investing in this space, and we do not see that over time investments will start flowing into the sector, and this ensures a persistent supply deficit compared to that of the demand. So at the backdrop of whatever that's happening now is none other than that of inflation. So commodity prices, they have been one of the main drivers of what has become one of the highest inflation in a generation. So in the next slide, you see that inflation is now running at the highest levels in a way that we have never seen before. I gave the example of the US CPI index, which actually increased 8.6% year over year, and this exceeded all expectations in May. So in a high inflation environment that we are currently in at the moment, commodities, they typically outperform other asset classes. And overall, there's a strong correlation between that of the Bloomberg Commodities Index as well as the US CPI Index. And what this means is that it actually highlights the effectiveness of commodities as an inflation hedge, as seen in the chart above. So given that there are many supply constraints out there, which continue to mean that the commodity supply would be unable to catch up with this demand, we do expect that commodity prices will continue to remain elevated in such an environment. And so what this also means is that commodities-related equities, they remain a decent hedge in one's portfolio. So with all this being mentioned, we think that oil prices could actually remain elevated and could reach $150 a barrel. And this would be driven none other by the factors as mentioned previously, such as the pent-up demand for travel, busier road traffic, inventory shortfalls, as well as OPEC's output constraints, as previously talked about. Not to mention the higher crack spreads, and these higher margins for global oil refineries would mean that those refiners with spare capacity, they might actually want to ramp up production, and this leads to increased demand for crude oil and thus higher crude oil prices. And beyond this, another positive catalyst to take note of is actually that of China's recovery. So China's recovery in the event of the easing of lockdowns would likely to be another positive catalyst, and we've actually started to witness some signs of this in early June after China had announced an end to its 2-month-long COVID-19 lockdown. Another thing to note is that a further escalation of the Russian-Ukraine war would also be beneficial to oil prices. So in the next slide, we think that these high oil prices are here to stay because of the fundamental improvement in supply capacity that will actually take time to ramp up. And this lack of investment within this space is actually a long-term trend that we have witnessed. So this results in a lag between the demand and supply will actually take time or years to actually fill this demand-supply gap. As such, the current demand-supply dynamics are supportive of these high oil prices. And with this in mind, investors may actually wish to consider these products such as the BlackRock World Energy Fund if they are seeking a dedicated energy fund out there. And this fund is invested in companies that are involved in the exploration, development, as well as production and distribution of energy. Other than that, they may also wish to consider other commodities-related funds that we have out there, such as the JPM, our Global Natural Resources Fund. And this fund not only invests in oil, but also in those companies that are involved in the metals mining space. So last but not least, another product that you could perhaps consider is that of the BlackRock Natural Resources Growth and Income Fund. And this is a fund that is well diversified across different commodities with an allocation into the mining, energy, and agriculture sectors. And with this, I actually come to the end of my presentation. So thank you very much for your kind attention.